What's up everyone, welcome back to my channel. For those of you that don't know me, my name is Miguel and I love making personal finance and fitness content. Today's video we're going to be going over ETFs. What are ETFs? Why do you need them? If you're brand new to investing, why is everyone telling you to get into ETFs first? And ultimately giving you my reason why ETFs are not the way to go for beginning investors. Be sure to subscribe to the channel if you haven't already, like the video if it helped you out, leave a comment if you have any questions and I'll get back to y'all. But without further ado, let's get into the video. So I'm going to be putting timestamps in the video, so if you already know what an ETF is and you want to skip to the other part, feel free to right here. But what is an ETF? An ETF is an exchange traded fund, but if you don't know what that is, basically it's one stock that has exposure to multiple other stocks, with the most famous one being of course the S&P 500. So the S&P 500 is actually made up of 505 common stocks, including over 30 companies. So if you're brand new to investing and you don't know which stocks to invest into, obviously ETFs sound like a pretty good way to go. The reason for me making this video is not to discourage you from investing into the stock market. The goal of this video is to help y'all learn from my mistakes and essentially give y'all a 7 to 8 month head start on your investing journey, because that's where I'm at right now. And if I were to start over today, I would definitely do a lot of things differently, including investing into ETFs. When I first started investing into the stock market, I did invest into ETFs. I didn't know what I was doing. I figured, hey, why not buy an ETF that's made up of multiple stocks so I have diversification and I have a safe dividend yield coming in. But there is a fee for using ETFs. So on average, an ETF charges about 0.44%, meaning that for every $1,000 that you put in, at the end of the year, it's going to charge you $4.40. 44% is on the low end. The average cost for an index fund is 0.74%, meaning that for every $1,000 that you put in, it's going to be $7.40. Now, by starting with ETFs, I did see a great return on my money. I first started investing into the ETFs SPHD and PEY, which I continue to have some of those shares in my portfolio today. The reason I invested into those ETFs, again, was because I wanted that safe dividend income while also having some exposure to the entire market. But as my portfolio is now nearing $10,000, I feel comfortable saying that beginning investors should not invest in ETFs, because you can see a greater return investing into individual stocks, and more often than not, these are the stocks that are already in the ETFs themselves. To help explain what I mean, I'm going to be using 3 stocks as examples to why beginning investors shouldn't invest into ETFs, because you can see a greater return from these individual stocks than you can investing into an ETF that charges you an annual fee. The first example is Domino's. Now when you think of Domino's, you just think of pizza mainly, but Domino's is at a 0.83% dividend yield, and they have been paying and increasing their dividends for the past 8 years now. And when comparing Domino's to the S&P 500, in the past 10 plus years, Domino's has seen a return, as we can see, of about 21,000%, while the S&P 500 has returned about 300-400%. Personally, looking back on it, if I would have known that Domino's had such a great return when I first started investing, of course I would put it in my portfolio while also putting other stocks that are similar to Domino's getting a greater return than the S&P 500, so I don't have to pay that annual fee, and I'm also getting a greater return on my money. Oh, and did I mention you also get dividends for it, while you're also getting greater return for your money. Now looking objectively at it, on paper, Domino's is performing way better than the S&P 500, but of course as a beginning investor, it's hard to invest into individual stocks when you feel like you don't know what you're doing. But I think one of the more important things to remember when you're beginning to invest is that we kind of have to take emotion out of it. On paper, in the long run, time in the market always beats trying to time the market. So the faster you get in, the quicker you're going to get those dividends and you're going to see that higher return. The next example of a company beating out the S&P 500 is the tech giant Apple. I personally have Apple, and just in the past 3 months alone, I've gotten a 13% return from Apple. Now, I'm pretty sure everyone knows what Apple is at this point, but if you don't know, Apple is a tech giant that produces phones, computers. They now have trackers. They're a really big tech company competing with the likes of Microsoft. They're at a 0.61% dividend yield, and Apple are actually only one of the 31 dividend kings in the stock market. So when you compare Apple to the S&P 500, we can see that in the past 10 years, Apple have increased by about 1,380% versus the S&P 500 that have only increased about 304.6%. Now, Apple is a part of the S&P 500, so if you own S&P 500, you do own some of Apple, but you are paying that annual fee when you could just be owning them yourselves and be collecting those sweet dividends and also that return. And the next stock that we're going to compare to the S&P 500, the tech giants Microsoft. Now, as we can see, just in the past 3 or 4 months since owning them, I've gotten a return of 23%. That's insane. But they have a dividend yield of 0.82%, and Microsoft have been paying and increasing their dividends since 2003. And when we compare Microsoft to the S&P S&P 500. Just in the past 2 years or so, Microsoft saw a return of 75%, while the S&P 500 saw a return of about 22%. Again, if you do have stock in S&P 500, you also own some of Microsoft. Now, I believe why invest into an ETF when you can go straight to the source and own some of Microsoft yourself. Now, by all means, if you're a brand new investor and you're seeing this video and you still don't feel comfortable investing into individual stocks and want to pursue ETFs first, I still think that's a great idea, because I first started investing into ETFs to get some exposure to the market and kind of build up my tolerance. But the point of me making this video is to help you all learn from my mistakes. And if I were to start my dividend investment portfolio over today, I would not invest into ETFs because you could see a greater return investing into individual stocks, and you could essentially create your own ETF for free. But like I said, if you're brand new to investing and you still don't feel comfortable, play it safe and go with your ETFs. As always, you gotta do your own research before you invest into anything at all. But I hope this video helped y'all learn from my mistakes. Don't forget to leave a like on the video, comment if you have any questions, and of course subscribe to my channel if you haven't already. Thank y'all so much for all the love and support that I've been getting on my channel here recently, as well as on TikTok and Instagram. If you haven't followed me on there already, be sure to check it out and follow me there. But I'll catch y'all on the next one. Peace.